This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. Episode 63, and on today's episode we had Tim Nash, the Sustainable Economist, as he named himself.
What a cool guy. What a background. Fascinating interview.
Yeah, he does a great job telling his story, so we won't tell it again here.
But man, does he have passion, and to take it from a philosophical as well as an environmental view was pretty amazing.
Yeah, and he's got some great views, clearly intelligent and well-thought views on sustainable investing and how that impacts the environment, but it also impacts the well-being of the people who are investing that way, as he describes it.
So he seems to have built a bit of a profile for himself. He's he's been on the National, and he's been on, BNN and Bloomberg. So I think he's become a bit of a go-to resource for a lot of people who are looking for solutions to have portfolios that reflect how they want to invest and how they want to make an impact.
Yep, and he's part of the growing fee-only planning space in Canada, which is interesting. So anyway, if you have anything to say with the episode, as you know, we'd appreciate it if you head over to the rationalreminder.ca website and leave a comment on the post. And there's also an article that Tim mentions in the episode that we have linked on the rationalreminder.ca website.
So there you go. Enjoy Tim Nash, who's the founder of Good Investing.
Tim Nash, the Sustainable Economist, welcome to the Rational Reminder Podcast.
Thanks so much for having me on. I'm excited.
So tell us, how did you become the Sustainable Economist?
Sure. So my background is in economics and philosophy. So I did my BA in economics at Dalhousie out in Halifax, and then just sort of took all the philosophy electives that I could. I had a lot of issues with the economic system that I was learning. So I actually went to Sweden and did my master's in sustainability. Came back, I'd done my thesis focused on this idea of responsible investment, looking at financial materiality of these sustainability issues. Came back to Toronto in July of 2008, ready to take the investment world by storm. And 3 months later, the market crashed. So there were no jobs available. This whole idea of sustainability totally got thrown on the back burner. So I really struggled for the first few years trying to figure it out. And then I got a little early inheritance from my grandpa, which wasn't a huge amount, but it was enough to pay off my student loans. And I wanted to invest like 7 or 8K inside a TFSA. I looked at the different options available, fell in love with the couch potato approach using these passive index ETFs. But when I looked at the companies inside of it, I kind of gagged. Like there were just companies in there I couldn't stand. So that's when I started researching socially responsible and green ETFs. I created my blog like myself, like I played around with Photoshop, turned myself into Superman, and just kind of like threw up my model portfolios, based on the journey that I was going through. And then from there, people started reaching out saying, Tim, this is great. I love it. But how the heck do I actually do this? And so from there, I've sort of shifted my focus, and at that time I was teaching economics at Sheridan College. And I was just sort of like, making ends meet however I could. And then it's sort of grown into a financial planning practice where now I've launched my new brand, which is Good Investing. And really, I'm a fee-for-service financial planner teaching people how to actually do this.
So are you still teaching economics or is the...
I'm not.
Okay, wow.
I quit the job probably 2017, so a couple of years ago, and kind of went full on into financial planning and haven't looked back. Things are going really well, and I'm kind of trying to figure out now, there's been a surge of demand over the last few months, and so starting to think about expanding and maybe hiring another financial planner.
That's super cool.
Yeah.
So you're doing financial planning and portfolio suggestions to people? You're not doing the actual implementation, correct?
That's right. So I'm not a broker or a manager. I'm not registered with the Ontario Securities Commission. The way it works is I provide research and coaching. So I'll never tell people exactly what to buy. I'm always going to show them a range of options and really help them understand those options and the trade-offs there. I am allowed to help with things like asset mix and tax optimization. And then really where a lot of people get value is basically like holding their hand as they buy an ETF for the first time. So getting them to share their screen with me over Skype or sitting next to them and just helping them understand like a limit order versus a market order. And it's really scary the first time people do that. So, it's a combination of sort of this kind of like research, coaching, financial planning, And then really just that sort of that hand holding and oftentimes the accountability piece to make sure that people actually do implement their plan.
Interesting. We could have a whole other discussion on like full service wealth management versus fee for service, but that's not the direction I want to go today. So you mentioned that you became the Sustainable Economist and started your major model portfolios because you felt bad about some of the companies that were in the index. And I totally get that. But because you're an economist, I want to ask you from an economic perspective, by not investing in bad companies, are people actually having an impact?
Yeah. So there are a couple different approaches when it comes to this. Okay. So typically when, we talk about responsible investing, the first thing that comes to mind is this idea of negative screening. So getting rid of entire sectors, often this was started by the Mennonite community here in Canada. So we often call them like sin sectors. Things like alcohol, tobacco, pornography, military, and personally, like I've got no problem with alcohol, but that is often one of sort of the default screens here. And so another strategy is ESG integration, which is this idea of environmental social governance analysis, where we're giving companies these sort of ESG or sustainability scores, and then usually getting rid of the worst of the worst, although sometimes picking the best of the best. And then the last thing is going to be this idea of impact investing, where instead of sort of doing less evil, really the option is doing more good. And whether that's going out of your way to invest in renewable energy or, water infrastructure or these sort of investment themes on the market. But there's also this really cool sector of impact investments, which are going to be things like community bonds, green bonds, microfinance. So, I think you're asking me more about the market securities, things that actively trade on that secondary market, which I'll address in a moment. But really, in terms of that positive impact, where a big chunk of it comes out and where it's sort of indisputable is really through these impact investments. By carving out part of your portfolio and investing in a community bond from a local nonprofit or a green bond or microfinance, you really are having that direct positive impact. So I think that side is basically indisputable. When it comes to the secondary market, that's where things get a little bit complicated because obviously unless it's an IPO, really me selling a share, I'm just selling those to another investor. And my little, TFSA, RSP, obviously I'm not having an impact there. Like I'm not going to pretend that my, $30,000 retirement portfolio right now is really having any impact there. But we are starting to see this broader trend when it comes to pensions and larger pools of money. And this is really where the impact is through kind of the invisible hand of the market. Obviously, if I buy fair trade coffee, and go out of my way to do it, I'm not, really helping farmers that much. I don't drink that much coffee. But if everyone starts to do it, now we're talking about, systemic change throughout that supply chain. And in the same way, what we've really seen, the impact that we see in secondary markets is through a company's cost of capital. So if I look at something like tobacco, which was probably one of the earliest negative screens, where you now have in the ballpark of $7 trillion in the capital markets that have completely, divested from tobacco. What that means is that it's harder for tobacco companies to raise money, either through a secondary offering within the equity markets and through the bond market as well. So in my master's thesis 12 years ago, one of the direct impacts that we looked at is that if enough investors start to sort of ostracize a sector or a company, then that's going to drastically raise their cost of capital, limiting their ability to grow. And the opposite is true, that if a company is a leader in sustainability, where companies are, big investors are going overweight, that's going to lower their cost of capital. Really, we're seeing this right now at this moment in time with coal. That coal has really kind of hit this tipping point where now, especially a lot of the big European foundations and development banks are just no longer financing coal. What we're seeing is that that's pushing a lot of new projects out of profitability because their cost of capital is now much higher than what it would have been otherwise. Does that make sense?
Oh yeah, that's exactly the kind of answer that I was looking for. And it makes sense logically, but it is really interesting. So even though people may be having a small impact, everybody acting together should anyway, increase the cost of capital for these bad companies.
You got it. And so really my dream, and we'll get deeper into it, but is that, for these sort of ESG or socially responsible funds, to have these massive assets under management, for this sort of to become a default way to invest, that's really going to use financial markets to build a more sustainable economy. And in my mind, it's really going to stabilize the entire economy, by sort of reducing our exposure to some of these big risks, whether it's income inequality, climate change, water impacts, like take your pick, but these are all major systemic risks that right now are really considered like externalities and are just simply ignored by the traditional capital allocation models.
So I've got to ask though, so negative screening, we're going to increase the cost of capital for these bad companies. What about the argument where, like, I know a lot of the bigger ETF companies now, like Vanguard and iShares, are getting more focused on proxy voting and governance. Is there an argument that you could have more of an impact by owning the bad companies, but exercising your proxy voting rights to affect change?
Yeah, and again, this is an invisible hand thing, so again, my little RSP TFSA won't have that impact. But when Vanguard and BlackRock step up, now we're talking. And what I would say is that I think that the proxy voting, which is really activating your shares, pushing the company in a more sustainable direction, is really useful for companies that are kind of like on the fence, right? Where, or in sectors that are like somewhat benign. Where I really think it falls apart is when we look at companies. So for example, when we look at the issue of climate change, and there are so many companies that are pure play, natural gas, fossil fuel, oil and gas pipeline companies. I remember being at a responsible investment conference probably 7 or 8 years ago, and there was a representative from, I believe it was Encana, and they were just like, listen, we're a natural gas pure play. This is what we do. This is why investors buy our shares. We're not going to pivot, right? So when it comes to, a tobacco company or a military company, shareholder engagement might get them to clean up their act a little bit. It might get them to, have better health and safety or environmental policies or, gender diversity on the board of directors, which are all important things, but we're not going to have that sort of systemic shift.
Right.
Whereas, a company like, one of the great examples for me is Unilever, right? Where they were really interesting and they had the CEO come in, Paul Pullman, who was like, I'm not going to do quarterly reports anymore. I'm only going to do annual guidance, annual reports to give these sustainability measures sort of time to breathe. And there was pushback from investors, but now they've started to realize that, hey, actually, this gets us away from the short-termism. And if you're a long-term buy and hold investor, which index investors, like this is what we are, right? We're long-term and we're universal owners, like we own the entire stock market. Now, all of a sudden, by having shareholders on board with some of these changes really helps these companies to shift in that direction from a longer term perspective. So, I'm a little bit, for me, the shareholder engagement argument, it's not going to be a top priority for me, right? Especially when it comes to the things I simply don't want to buy, but definitely I do view it as a way to be able to push companies in a more sustainable direction. Although ideally, like if I'm right about the capital market argument, as more funds are allocated with this ESG lens in place, we might not even need shareholder engagement because now, companies are going to be competing with each other,
right,
to get included in those indexes, to compete not only on profitability metrics, but also on ESG metrics.
Super interesting.
So I got a question about individual investor choices and how much impact they can have themselves, whether they choose to fly less, whether they choose to use less natural gas in heating their homes. And because so much, I believe we can make our own decisions that have an impact before we even choose on how we invest our portfolio. I'm curious in the people you're seeing and talking to, have they done everything they can personally? And I ask because often we've had meetings in the past where someone will, have a lifestyle that burns a lot of fossil fuels in their lifestyle. Yet they want to make sure they don't own fossil fuel stocks in their portfolios. Like, how do you square, perhaps as a philosopher, those two sides of the equation?
Yeah, so, I want to start the conversation with an admission. I'm a hypocrite, right? I wear clothes that have a carbon footprint. I eat food. I eat meat from time to time. You know what I mean? I'll often rent cars and go on road trips that burn fossil fuels. Nobody's perfect, okay? And and you got to understand that individual actions will only take us so far. that I think we've been sold a bit of a myth that it's like, the way for us to, deal with global climate change is to stop driving or stop flying or buy an electric car. And frankly, these are systemic issues. Our economy systemically depends on fossil fuels right now, and no amount of personal action is going to change that. So, really what I would say is that two things. Number one is that, everyone's going to, have some carbon footprint, right? And certainly I would hope that people, and certainly my clients, usually go out of their way to reduce that personal impact. But the impact that we can have with our portfolio is actually many times higher than the impact we can have through those decisional individual actions. I'll refer to a blog post and a study that was done by a group called CoPower. And I believe we'll be able to put this link in the show notes at the end. So if people want to take a look at this infographic, it's really useful, because what they did is they did an analysis looking at the carbon impact of various activities, including, one round trip flight, driving a gasoline car, eating an omnivorous diet, so having meat in there. But when you look at a 100K portfolio, and certainly at a 500K portfolio or $1 million portfolio, the carbon footprint of that investment portfolio dwarfs those individual actions. Just to give you an idea, like the biggest one would be eating an omnivorous diet, generates about 2.5 tons of CO2 per year, whereas a 100K portfolio generates 9.3 tons of CO2 per year. Now, bit of a caveat, obviously they looked at 100% equity portfolio here. And in their methodology, they did do a 50-50 mix of Canadian securities and international securities. So really, it's important to understand that Canadian investors have a huge carbon impact through their portfolio. But when you look at the breakdown of the TSX 60, it's overwhelmingly, oil and gas, pipelines, mining companies, and banks, which when we look at the holdings of the Canadian banks are overwhelmingly, overweight oil and gas, pipelines, and mining companies. So, really it's the type of thing where what I would say is that, obviously we want to look at every way that we can minimize our impact. As an environmentalist, I'm constantly looking for ways to minimize that impact, but we have to make choices. And I'm never going to be in a position of judging to say that one choice is necessarily better or more important. But my argument is that, for me to avoid going to a family barbecue because they're serving hamburgers, something like that, I don't know how much of an impact I'm going to have there. Whereas, the work that I'm doing by, if I can help 1,000 clients divest from fossil fuels, now we're in a situation where that's pushing towards a more systemic change, right? And then obviously we need government stepping up and more regulations, things like a carbon tax. Like, I'm so disappointed by the rhetoric right now. We're arguing, should we or shouldn't we? Whereas really the question should be, how high of a carbon tax should we be having right now? Like, this is a very clear economic issue. And then the last thing I do want to point out is that, for those clients of yours that, maybe fly or drive an SUV or whatever, but are looking at this, there is the ethical imperative to divest from fossil fuel. There's also a very real financial one that, we are moving away from fossil fuels at a very quick rate. And that if you look at this idea of a carbon bubble, which is that so many of these fossil fuel assets are listed on the balance sheets of companies, and if we add up all those reserves, that would push us way over the limits in terms of Paris agreements and limiting climate change to 1.5, 2 degrees Celsius. If we're serious about enforcing and meeting those climate targets, then we're going to have to leave a lot of those reserves in the ground. That means those companies are going to be writing them off, which means that their share prices are going to take a very serious hit. So there's also a sheer, the Bank of Canada has identified climate change and this idea of a carbon bubble as now one of the top 5 systemic issues facing the Canadian economy. And Canadian investors need to be very, very careful on a purely financial level that if they're heavily exposed to the Canadian market, understand that that Canadian market is heavily exposed to carbon risk. I could argue that those clients, do whatever lifestyle they want, that this is a pretty effective risk mitigation strategy when it comes to that specific risk.
Yeah, it's interesting. I hadn't heard the term carbon bubble before, but that's an interesting concept.
Yeah. It's now, Mark Carney talked about this when he was governor of the Bank of Canada. He's still talking about it in England, although I think he's got bigger issues on his brain right now with Brexit going on. But that, this is, and again, to have that most recent Bank of Canada report come out and sort of start to use this language, we're now starting to see there's something called the Task Force on Climate Disclosures, right? And this is now like basically banks are running stress tests based on their climate risk. And this is the first time they're doing it. And those risk assessments are not priced in to current market prices.
So you've written a couple of amazing posts where I think you critiqued Wealthsimple's SRI portfolio and also the quite popular, I believe, Jansi Index. And in both cases, you found that a lot of the holdings, and I've been through this as well, a lot of the holdings are major turnoffs.
Yeah.
How do you assess that, and how do you assess whether or not it meets the criteria that you use?
Right. So, I want to be clear that when it comes to this, everyone's going to have a different definition, right? And everyone's going to draw the line somewhere else. And again, I don't judge. I don't care, what people do. But again, my clients tend to be, and I'll speak for myself, I'm a little more on the sort of tree-hugging hippie side of things, so, for me, I do have pretty high expectations, but, it's been such a disappointment for responsible investors in Canada. I can't tell you the number of people who have come to me and, they bought something like an ethical fund. Like there's a group called NEI, Northwest Ethical Investments, and, it's billed as this ethical fund. And then they open up the companies inside and ExxonMobil is in there, and it's like they would justify it by saying, hey, we're doing shareholder engagement. Or, maybe it's underweight relative to their peers. But, I think a lot of Canadians for a long time have really been disappointed by these sort of socially responsible offerings that they don't go far enough. So, one of the biggest values that I do is I'm really good at like opening them up and looking at what's inside. What's great about ETFs is that they're way more transparent than mutual funds. So typically the process that I go through is twofold. The first thing is I examine the underlying index methodology. So I won't get that from the ETF company itself, but obviously all of these ETFs replicate a specific index. So MSCI, Vanguard uses FTSE. In the case of the iShares Jansi Social Index ETF, they use the Jansi Social Index, which Jansi Research was one of the first companies. The guy Michael Jansi founded it. They've since been acquired by a company called Sustainalytics. And Michael Jansi is now the global CEO of Sustainalytics. And that when this was created, the Jansi Social Index, I believe it was like the late 90s. Again, it was really this idea of religious communities. So the methodology they use there is they get rid of the sin stocks, alcohol, tobacco, pornography, gambling, military, guns, things like that. They also use that ESG research, but they only get rid of the bottom 20% of the sector based on that ESG score. So they're really getting rid of that bottom quintile of companies, sector by sector. And then, really what's disappointing for me is that there is no climate perspective here beyond that sort of broad ESG score where carbon footprint would be a small slice of that E score, that environmental score. So, it was created at a time where, honestly, I think nuclear energy was viewed as a bigger threat by environmentalists than fossil fuels. And in my mind, it hasn't kept up with the time. So that's why when I look at the top holdings of the Jansi Social Index, Suncor will be in there. They're considered the most responsible of the tar sands companies. And I'll use tar sands here, although sometimes I'll often talk about the oil sands, but I feel comfortable with you guys, so I'm going to talk about tar sands. That, they've got the highest ESG score of tar sands companies. That said, for myself and a lot of clients, like that's a no-go. I don't want a penny of my money in Suncor. Same thing with pipelines. What's interesting is that Enbridge is excluded from that portfolio. And largely because my understanding it's because of a major controversy. So again, they will monitor for controversies. And if it's a major one, it will get excluded. There was a big oil spill in the Kalamazoo River in Michigan a few years ago. And I believe that was a severe enough controversy to get rid of Enbridge. However, Pembina Pipeline is still in the Jansi Social Index, right? You're still going to get mining companies. You're still going to get, and really their methodology, it is what it is. But they're trying to replicate the TSX 60 with this ESG screen and responsible screen, which they've done a great job of doing. The Janssen Social Index has actually outperformed the TSX 60 over the last, I think, 5-10 years, right? So they've done a really good job of doing that. But that, for me, it's really about, number one, looking at the underlying index. How far does it go? Number two, looking at the companies inside. And are there any in there that kind of make me want to gag? Right? And then that's kind of how I do my analysis. From there, what I do is a financial analysis to look at how closely it does track the sort of benchmark. And ideally, we want something that tracks the benchmark, the TSX 60 or the All Country World Index, if it's a global fund, right? And so really what I'm looking are companies that track the index as closely as possible, with very high sort of ESG screens in the methodology. And then ideally that don't have any companies in there that sort of don't pass the smell test for me. When it comes to Wealthsimple, there it's a little more complex because they use a whole bunch of different ETFs. The issue I have with Wealthsimple is they tried to do everything for everyone. So when they created it, there was a bit of a bifurcation in the ETF market where you could either have socially responsible ETFs like the Janssen Social Index, which get rid of those sin stocks but don't still have fossil fuels, or you would have fossil fuel free ETFs that don't have fossil fuels but still have like guns and weapons and those so-called sort of sin stocks in there. What they did is they did both, right? So they've got like sort of the iShares low carbon target All Country World Index, as well they have the Janssen Social Index. So what this means is they still have weapons and tobacco through that low carbon approach. And then they also have tar sands and pipelines through the socially responsible approach, which, in being everything to everyone, I think they ended up kind of pissing everybody off. Because no matter what your ethics, if you're trying to, avoid these types of things, there's going to be something in that Wealthsimple portfolio that you're not going to be happy with. And again, my job isn't really, I'm happy to do it for my own portfolio to say, what my red flags are and what's like a thumbs down for me. But really, I try to do that analysis and not sort of cast judgment in terms of, is this sort of good versus evil? Really, I want to present people the information and then empower them to make the decision for themselves. Obviously, that responsible portfolio is a better step, a step in the right direction compared to their traditional portfolio. But I do think that, for a lot of sustainable investors, they have these expectations. And when they open up those ETFs and actually see what's inside, it's not going to meet a lot of people's expectations.
It is an interesting point, because I think that when you sign up for Wealthsimple, you get a choice. Do you want a regular portfolio or a socially responsible portfolio? And I'm sure a lot of people just say, well, yeah, I want to be socially responsible. But like you're saying, if you opened up the portfolio holdings in aggregate, forget about the names of the individual funds, it's probably going to piss everybody off.
Yeah.
So it's an interesting point.
And that to me is why, this idea of responsible or sustainable investing dovetails so nicely with the DIY approach. Right? Because to me, it's just an absolute no-brainer that really it comes down to customization. Everyone's going to have a different opinion, a different perspective, a different philosophy on these issues. Anytime you're buying a fund or hiring a full-service manager, you're kind of outsourcing it to their ethics, to their definition. Whereas this DIY approach, it's great. We can fully customize. I've done a vegan portfolio. I've worked with anarchists before.
Well,
right?
Hold on. Back up. What does an anarchist portfolio look like?
So an anarchist portfolio is much more heavily focused on what I would call the doing more good side of the equation, right? But what I would say is the way I didn't pitch it to them, they came to me, but the way is that basically this is their hedge in case society doesn't collapse.
That's amazing.
Right? Because the worst case scenario, think about it, Ben, you're shaking your head at me, but think about it. That the worst case scenario for an anarchist is that the capitalism perseveres, right? And they don't have retirement savings, and they now end up in like a state, long-term care facility.
Yeah.
So this is basically if, the world goes to hell and it all falls apart, then that's fine. It is like, it doesn't matter where your investments are. However, if it endures, this is sort of their hedge to be able to like make sure that they can have a retirement. And then really, again, we focus a lot more on the thematic So sort of these broad sort of, environmental themes and sectors that are sort of doing more good. And then as well as those impact investments, community bonds, green bonds, microfinance. What it means is that certainly their portfolio is a little riskier than an average portfolio, but what we end up having is just sort of more bonds, to be able to account for that. But like both the vegan portfolio and the anarchist, like those definitely deviated from the standard benchmarks. But really for a lot of these clients, if they're not doing that, the other option is like keeping it in savings or like under their mattress or really like losing money to inflation. So I get a lot of people that come to me where like they would not be investing in the market if not for my services in this approach.
It's fascinating. And for the record, I was shaking my head like, not disagreeing. I was shaking my head like, this is amazing. This even exists. Like, really?
I tell you, like my clients are some of the best people. I get people from all different backgrounds with all different sort of, ethical beliefs. And again, for me, my job is not to cast any form of judgment, but really just to listen to them and hear them and then to help them understand that they do have options. And what are those options and what are the trade-offs? And, sometimes the fees are a little higher or you're not as diversified, right? But really to help them understand that, and then to do it in a way where, looking at asset mix and, if you're an anarchist, you don't want to pay taxes. So doing the tax optimization piece is really important. Let's use that tax-free savings account to its best ability.
But in aggregate, all these people with customized portfolios are the market, right? Because if everyone else is the market, so the market plus the people tilting to avoid parts of the market, they must add up to the market. Therefore, mathematically, they are the market, right? So how much impact are all these people having?
Yeah, and I mean, I think for them, a lot of it is on the personal side. It is on sort of the warm fuzzies.
The preference.
And a discount, right? And so, so for me, it's like, again, if everybody does this, then we can talk about the invisible hand and we can talk about, sort of those broader systemic shifts. Straight up for most people, they're coming to me and the main driver is just that they want to feel good about it. And that historically they would have had to have sacrificed so much. The socially responsible mutual funds, they just gouge you on fees. Like mutual funds are already a ripoff. And then the SRI mutual funds are just so much higher. So, for me, what I'm doing is really helping them do it in a way that is more in line with their values, that they actually understand what they're doing. I mean, I'm sure you guys know the lack of financial literacy that exists in Canada. Now take that to like environmental communities or, social justice activists, right? Like they don't understand. They've never been taught these things. And most of them have an aversion to it. So now all of a sudden I'm able to use their language, teach them about ETFs, teach them about stocks and bonds in a way that's accessible and in line with their values. Now all of a sudden they have a retirement portfolio that they can feel good about. And hey, like the returns have been just as good, if not a little bit better than a lot of the traditional index portfolios.
Yeah, it's interesting. I have to throw this in there. I know I sent you the blog post that I wrote a while ago on this. Our listeners are fully aware of factors and factor investing. I've looked at a couple of different ESG or SRI indexes in the past, and maybe you have an idea of why this is, but they tend to have excess exposure to the profitability factor, which explains a lot of the outperformance.
Right.
Yeah, anyway, just an interesting side note.
So can I speak to that?
Please, yeah.
Yeah, so, and it was really interesting. I loved your blog post. I was so excited because it's like, I am a nerd like you are. And so to have you looking at this and examining it, and, we can have difference of opinions here and there, but, I love it anytime people look at this. So the factors that you described, so the first one was RMW, which is robust minus weak, which is a profitability score. And then the other one that you looked at was QMJ, which is quality minus junk, which are both profitability metrics. And for me, what I want to communicate is that my takeaway from this is that ESG screening is a great way to get higher quality and avoid junk, and to find robust companies and avoid weak ones. And so my argument is that, we're basically comparing two strategies here. The first is just a standard, all country world index, looking at just financial metrics. The second one still looks at all of those financial metrics. In addition, looks at environmental, social governance, ESG risks.
Yep.
You're going to make a better decision if you have more information.
I agree. Yeah.
And so to me, the gap is that in the traditional financial market, we don't have perfect information here. We're ignoring all of these externalities in terms of environmental, social, and governance issues. And we see these issues pop up time and time again, and it has a drastic impact on share price. And I'm sitting here like, why are people surprised? Like, look at SNC-Lavalin.
Right.
Like, we know what that company does. We've known that for a very long time. And now all of a sudden people are surprised that they're embroiled in a controversy like this.
Yeah.
Right? Like, come on. The only way, you didn't see that coming is if you ignored governance issues, right? When it comes to, so many of these different companies, really, I would argue that ESG is this extra layer of due diligence that gives us better information, that there is a sort of a business case for sustainability that is super obvious. You've got lower energy costs, water costs, material costs, because they're more efficient. You've got employees that are more productive and actually really care about the companies they're working for. And then you have customers that are more loyal and often willing to pay a premium for organic, fair trade, ethically sourced goods. So, I did this 12 years ago, guys. I was wearing my economist hat saying, wait a minute, higher revenues, lower costs, a more productive workforce. This is a recipe for sustainability. And frankly, this is what the smart money, the pension plans have now caught on to. And this is why Ontario Teachers Pension Plan, Canadian Pension Plan, all the big money is now doing this ESG analysis, right? This is where the smart money is. My fear is that it's individual retail investors that are going to be left holding the bag, that they're the ones still operating on the just financial metrics, which is imperfect information, which means that they own more junk, right? Which means that in the event of like the carbon bubble bursting, they could be the ones end up holding those sort of now toxic assets. So really, to me, this is where the stock market is going. This is where the economy is headed. And we can argue about how long it'll take to get there. Had you asked me 10, 12 years ago, where would we be in 2019? It's like, I figured we would be past a lot of these debates. But there's no doubt that if your time horizon is, 10 years, 20 years, 30 years, 40 years, right? There's no doubt that these very systemic social and environmental risk factors are going to have a hugely material impact on share price performance.
But aren't individual investors also piggybacking on these pension funds? If they're doing the due diligence and they have highly diversified portfolios, they'd only be stuck holding the bag if they end up buying all the bad companies, right?
Which specifically from a carbon perspective is Canadian investors that have like a 30 or 40% allocation to the Toronto stock TSX 60. That's what we're talking about. And how many clients have you had come to you that have that 30 to 40% allocation to the Canadian market?
Well, that's low compared to the average Canadian portfolio.
Right. So, so specifically on a carbon risk there. And so again, there's a wide, it totally depends on the approach. But the biggest argument that I make for this stuff is that those pension plans are universal owners and index ETF investors are universal owners, meaning that the best thing for us is a strong economy, right? GDP goes up, we're all going to benefit. GDP collapses, we're all going to lose in that scenario, which means that we have a vested interest in stability. And when I look at the gap between, income inequality, the gap between the rich and the poor, I think is a huge systemic issue to our global economy. Climate change, I think is a huge systemic issue to our global economy. That really these universal owners have a vested interest in creating a sustainable, equitable, stable economy, right? Which is why it's like kind of a twofold thing. There's the sort of ethical imperative to this, but there is a very real financial imperative to assessing these risks and, doing what the financial industry does so well, which is efficient allocation, which is, underweighting the companies that have heavier exposure to those risks, and then hedging by investing essentially in the solutions to these problems.
It is an interesting concept. I think it just comes back to pricing. And if there would be a benefit financially, a systematic benefit to allocating away from bad companies, as we're calling them, I think that by definition means the market is mispricing those risks Because if the market's not, then those risks are already included. Anyway.
And I would argue that just like Warren Buffett identified sort of a reputational risk or like brand, as value before the rest of the stock market did and made so much money, I'm recognizing this intangible value and reputation, and brand in a company's sustainability leadership. And if I'm right with my thesis, then, you guys are going to have me on the podcast in another 10 years. Right. And all of a sudden, as that mispricing starts to balance itself out, we're going to be looking at this and that my model portfolios will have continued to outperform.
Interesting. Okay. So when you built your sustainable couch potato, I think that's what it was called, or the original
couch potato.
What's it called?
It's the organic.
Organic. That's what it's called, right? Sorry.
It's a potato. It's got to be organic.
Right. You're right. So when you built that, the products available were way more limited. And I know like iShares recently released a whole bunch of great low cost ETFs. So what is for people building these types of portfolios, what's the product landscape in Canada like?
Oh, it's so much better than it was a few years ago. I remember, and it was brutal because I had like an international equity ETF that was US focused, and then it ended up getting delisted. They changed it into a mutual fund, which was no longer available to Canadian investors. So I had to have like mutual funds and like F-series mutual funds. Oh, nightmare. So now there are way more ETFs available. iShares has come out with this whole new lineup. They don't go far enough for me in terms of they use an MSCI index that's like the weakest MSCI ESG index. I was very jealous because in the UK, iShares released a whole bunch that were very similar, but were a much more enhanced ESG index. As well, you've got Vanguard, which just came out with theirs. Again, very small step in the right direction, but for fee-conscious investors, those Vanguard ETFs are as cheap as they can get. I think it's like 12 basis points and 15 basis points MERs. From there, Desjardins just released a full lineup of responsible investment ETFs that are low carbon. As well, they have one that is fossil fuel reserves free, which I was really happy about. And then Horizons has their Global Sustainability Leaders ETF, ETHI, which I would consider now the most sustainable ETF in the Canadian market right now. The fees on it are higher. It's like 65 basis points, and that's before HSD. It hasn't been around for a full year. So I'm expecting like 0.72, MER ballpark. So it is a little more expensive, but it does give global exposure. And the methodology that they use is that, very squeaky clean in terms of those negative screens. They get rid of a lot of nasty stuff. And then as well, companies must have a direct carbon footprint 60% below the industry average, which for me, it's really quite stringent. So people that are looking to have that sort of low carbon footprint, that ETHI option is amazing. On the doing more good side, so the thematic investing, that's where it's a little more limited. Really, we only have the iShares Global Water Index as sort of like a green one in Canadian dollars. There are a couple of doing more good mutual funds. So you could look at the F-series. There's like a Mackenzie Global Environmental Equity Fund. NEI has their environmental leaders. AGF has the sustainable opportunities. You're looking with the F-series at an MER, around 1 to 1.25%. So it's not absurd, but obviously higher than I would like it to be. For the most part, we end up looking to the US, where there are a whole range of sort of green ETFs from, there's one that's linked to the UN Sustainable Development Goals. There's an organic food ETF. There are a number of different green, clean tech, renewable energy, so many different ones there. Obviously, those are going to be a little riskier, right? So anytime with this thematic investing, I always really caution investors, understand the risk, look at that beta to determine the volatility, understand that it's not properly diversified. So really that should be part of your portfolio. In my model portfolios, for someone with 40% bonds, 60% equities, I usually carve out maximum sort of 15% of the overall portfolio for those sort of doing more good options. But I'm really excited. There are more ETFs coming out all the time. I'll be real that the assets under management are pretty low still. That this is a concern for me, that there's more supply. But I think a lot of, there's a selection bias here where the type of person that wants these things doesn't know what an ETF is and wouldn't feel comfortable doing it themselves, which is kind of where I step in. So if I'm successful with my business model, we would see those assets under management rise. But for right now, investors do need to be cautious. They tend to be very thinly traded. So, really want to make sure that you're doing limit orders, not market orders. If you're investing a large amount, you probably want to do that dollar cost averaging and sort of spread it out over time. So, we do want to be deliberate with them. There are sort of some warts involved with purchasing these ETFs, but really that landscape has grown so much just in the last year. I did backflips when Vanguard came out with theirs, that pushed fees for everything down, right? And then iShares and then Desjardins, and Horizons, and I'm just like waiting for more to be available. But then, of course, it gets tricky for investors because how do they distinguish and how do they pick which one's right for them and sort through it, which again is why sort of the educational piece and I think the financial planning service I offer is so valuable.
So, yeah, this has been an amazing conversation. And I think you should take this chance to quickly tell our listeners, what is your service and who are you targeting and how do you help people?
Yeah, so really I help anyone that wants to invest their own money online and do it in a way that's in line with their values. So a lot of my clients come to me with very limited knowledge. Some of them come to me with quite a bit and just want to hire me for an hour or two. But basically, I describe myself as like an investment coach. So technically, I'm a fee-for-service financial planner. But really what I offer is research, education, coaching. I'm not allowed to provide specific recommendations, but I am allowed to offer lists of sort of suggestions. And then what we do is we open them up. I help people understand the trade-offs and how it works. They choose the specific products that they want to buy. And then I can help with things like tax optimization, asset mix, and then really actually making the trades. Again, you do want to be careful with these. Make sure that you're sort of not getting ripped off when it comes to that pricing. So I charge by the hour, which means I'm fully independent. I don't take any like commissions or sales charges. And really, I do operate on a sliding scale. So clients who have more money can afford to pay me more money, but clients with lower assets, I still want to be able to help them out. So, really by charging on that sliding scale, it means that I can help anybody, that's trying to figure out what to do with their money and would be comfortable with a DIY approach, right? It's not for everyone. Some people want that full service and that's fine, right? But what I do find, obviously I've got my bias, that this DIY approach is certainly the cheapest option. And then from there, it also allows us to customize based on an individual's sort of unique sustainability metrics.
Very cool. All right. I've got one more question to tack on, and this is a question that we try to ask all of our guests. And no pressure, but I've got very high expectations for your answer.
Uh-oh.
How do you define success in your own life?
In my own life. So for me, it's about helping people. So I'm on a mission. My change theory is to help 1 million Canadians invest intentionally. And so that's why I have the sliding scale. That's why I put a lot of my research on the internet for free through my blog. That's why I come on podcasts and I go on BNN and talk about this stuff to spread the word, because I just want to help people. And, really, I just find that, personal finance in Canada, so many people just don't have that financial literacy. And then, when they do get a little bit of it, it usually doesn't extend to sort of this part of people's lives and the impact that they are trying to do. So, what drives me, my favorite moment is the trading meeting when we sit down with clients and all the money is inside their accounts and actually buy the ETFs that are in line with their values. And we allocate part of it to a community bond or, microfinance. And they're just like, whoa, that was so much easier than I thought it was going to be. And I feel so good knowing what I'm actually investing in right now, that when that light bulb kind of goes on for them, that just warms my heart so much. And, my hope is if I can get 1 million Canadians investing intentionally, and again, I don't care what those intentions are, invest in whatever you want, right? But just look at it. And if you can do the responsible one and still earn good returns, I think a lot of people would choose that. But that's when I would hope that this would become a default option. Instead of going to a bank, getting sold a mutual fund, getting ripped off in fees and investing in Lord knows what companies, to have people actually make a deliberate decision and manage it themselves. If that was the default way for people to invest in Canada, I feel like everyone would be just so much better off.
I think you're absolutely right. All right. Well, Tim, this has been fantastic. We really appreciate you coming on the podcast.
Thanks so much. I'm a big fan. I love the work you guys are doing. So know that, happy to make myself available anytime you've got some more questions for me.
Awesome. Thank you.
Yeah. Thanks, Tim. And thanks everyone for listening.